fireside.
Ah, damn it! We were trying to get you to be late, Tanner. What the hell?
Good try. I know what you're doing, man. I knew what you're doing.
He is late.
I mean, I'm essentially late. It's 10:01.
If Tanner isn't like 2 minutes early, he's late.
Ladies and gentlemen, welcome to this.
Hold on. You're not introducing anything. We got beef. Tanner called me 10 minutes ago saying I got work in 10 minutes, like I wasn't going to be here. And two, Tevis, I need a favor from you.
Is that what he said? You have work in 10 minutes?
Yeah, he said I have work in 10 minutes.
Jeez.
Because it didn't show that I read the
cracking the whip.
Because it said I didn't read the Twitter message. When have I never not been here? And one time when
you guys earnings you weren't here. Why weren't you there?
Yeah, Rich, Tanner, you telling other people they're going to be late for this show?
Yeah, you're always late. But Tevis, I need a favor from you.
What's up?
All right.
I was hoping that I don't know. I was hoping to be on time, but and I just didn't hear anything from Steven. I didn't hear anything from Steven. He wasn't talking, and so I just called him really quickly to know where he is, to make sure he's okay. I was checking on his safety.
So Tevis, the favor is I need you to sell Sofi.
Okay.
Sell?
Why?
Oh.
Because you saw Palantir and it just goes up.
Yeah. I know.
And it went to a place today where I wrote some contracts on part of my position because the premiums got ridiculous.
Man, you would think with my selling of Palantir that these freaking cult members would be a little bit more grateful instead of just posting Palantir's stock chart on every Sofi post I make.
Dude,
Steven and I are grateful, dude. We love you. We're so grateful. And by the way, ladies and gentlemen, Palantir Weekly. Wait, no, that's not.
So if you can sell Sofi, we may be in business here.
Yeah.
Just saying.
Yeah. And then the next thing he buys is like the S&P 500 and it can just completely tanks.
I am the new Jim Cramer, yes.
Yeah.
My friends know this about me because this is not the first time that this has happened. I do these stupid trades. And like I've said it all the time, like I am a horrible trader. This is why I'm a buy and hold type of person, because I'm just brutally bad at this in the short term. And when I told my friend I sold Palantir and then Palantir's up like 20%, it was like at $18 or something. He's like, God damn it. He's like, I would have bought calls. Like, why didn't you tell me?
You on PayPal?
I only own Leaps. I can sell those.
Can you sell them, please?
I can, yeah. I'll take a loss, but I'll sell them for you.
Roy and I will be so freaking happy if you sell those.
And Tanner's in that one too, right? You're in PayPal.
Am I in PayPal?
Yeah.
What do we sit here and talk about every week? I
mean, unless I've missed something, like the way Steven was talking about it is like, did he dump? Like,
yeah, I'm in PayPal.
yeah. Just a little. Yeah.
I even invited Roy on to join us 4 minutes before this started, and he popped in. He was early while still having 4 minutes notice. So
love it.
I mean, give it up to him.
Love it.
Yeah, and then we were still late. So I don't know what's going on.
It's because of you.
I don't know about all that, but
I know about it. All I know is somebody was changing everybody's position on the camera and, dilly-dallying over here.
It wasn't by my design. I didn't ask for that. Okay, listen, ladies and gentlemen, we have some Sofi to talk about. So, the CFO Chris Lapointe just recently had a fireside chat that a ton of information was given. In my opinion, some good, some bad, but very transparent. Okay. Another one was that there was some rumors that had gone around for Sofi in terms of different product launches that they are potentially wanting to fast forward, delay. Let's talk about that. And I don't know if Tevis, if you have any other things this week. I know you love the recap. So anything else that you'd like to cover?
So there's smaller things that maybe we can just cover a lot of the small things, and then we can, have a longer discussion on the Chris Lapointe stuff. Web traffic was up for Sofi. I can also send you links. Institutional, I saw a lot of institutional movement on the new filings with a lot of the big institutions actually adding to their positions. I want to talk about Vadim's post on David Cavarini because I found that was really funny. And then we can talk about this like level 1 options, delay rumors that you were talking about on Tuesday, Tanner. CPI report, if we want to touch on that, but then we can jump into the Crystal Point stuff. How does that sound?
Yeah, sounds great. I would love to know the website traffic. Is that from TipRanks? Is that the one?
It was both TipRanks and SimilarWeb. I'm just going to send you a bunch of links in the private chat, okay?
Understood. I've been tracking the SimilarWeb one just because I found it to be less faulty than the TipRanks, but they do show very different numbers, which I find is interesting.
Are you using Koifin for that?
No, I mean, no, the two companies. The two companies, SimilarWeb and then TipRanks. And they give different statistics.
Mm-hmm.
I'm sure if Koifin made one, though, it would be perfect.
Okay, so I put the 3 sort of links of the smaller topics. We can start with web traffic. I mean, like you guys know how I feel about the web traffic. It's an impartial metric, but still a good sign, I guess, to see.
And then there is the SimilarWeb one, up 4% from last month, 13.1 million visits.
Yeah.
Very, very exciting.
I mean,
okay,
very, very exciting, but it's mildly amusing.
It's not very exciting too. 4% quarter over quarter.
Dude, the correlation between a sort of monthly increase in web traffic and new members is like, it's got to be like single digit percentages.
Sure,
if not lower.
Sure. I think there's a couple things because website traffic is not just it's not unique users, right? It's general traffic. So I think if things similar to what Robinhood is seeing, if there are more frequent uses like reasons for people to go to SoFi Invest, then you'll see website traffic go up because people will be checking multiple times per day. I don't think many people check their checking account multiple times per day as much as they do their investment accounts. So who knows? Could be ebbs and flows of the market when people actually want to check it. Holy, Matt Money coming in, gifting 5 memberships to the Tevis channel. Way to go.
He's just flexing his Palantir gains. This is how Matt just rubs it in that he's just rolling in the Palantir money. Hey man, I love it. Just
yeah,
it's fine.
Matt, I'm gonna text you.
Maybe we can jump into institutional ownership, Tanner.
Sure.
I found this was much more exciting than web traffic, especially because there's so much FUD that I'm just seeing that's associated so closely with the emotional overreaction of the stock falling. And
could you bring it up? It's not loading on. Oh, it just loaded. It failed 3 times.
And it's just really interesting to see because these institutions just keep loading up. So you can see, increases in positions by Vanguard, by BlackRock, by 2 Sigma Investments, JP Morgan, Bank of America, all the major players are just adding to their SoFi positions.
Yeah.
So encouraging to see, right? Because on one hand, you sort of scroll through the SoFi, hashtag on Twitter, and then you see all of these things about like macro recession, bear case left and right, and SoFi is not going to make it and all this stuff. And then on the other hand, you see all of these institutions adding up SoFi shares. And I think this is like the 3rd month in a row where they've consistently been just increasing their ads. You have a chart on Fintel B-Dubs where you can actually see this. So encouraging to see, right? Because there's a lot of discrepancy in terms of what's going on behind the scenes versus what's actually been talked about from a short-term emotional perspective.
Yeah.
So are all the 13F filings out?
Yeah, a lot of them came out this week, Steve.
All right, I'm going through it right now.
One of the great things about that, like people scream manipulation too often and like, it's these funds that are manipulating. Usually, I mean, who knows? It's really hard to prove that. But one thing is for sure is that when a company is actually executing and they're removing uncertainty again and again, they're willing to clarify when there's some major concerns, and there were some concerns that Chris Lapointe and Anthony Noto as well helped clarify. But institutions see that as a buying opportunity. They tend to buy during these times, and we're seeing them add again and again. And if we only thing that we take from that is that these big institutions say, okay, SoFi is actually a better deal. It's not that risky for us. We're going to buy. We're going to hold.
I'm just going through looking at Koifin really quick, in their ETF exposure and mutual fund exposure and ownership. So you can kind of see all of this sort of play out for SoFi. See who actually owns this company and how much of the company it actually makes up. Quite interesting. It's so funny. A VTI number one ETF that holds SoFi, but it's 0.01%.
Yeah, VTI has 1.3 or 1.7 trillion in assets under management.
No, I'm aware of VTI. I hold a lot of it. I'm just saying.
Did you read my article on it that came out today?
No, I did not.
Oh.
But I'm just saying it just goes to show you the scope or just the total scale of large ETFs. Like they could be the biggest holder in a company and still it's like a penny in the bucket for them. So yeah.
Vanguard has 76 million shares.
Got you.
They own 8% of SoFi, according to Whale Wisdom.
I think Vanguard, BlackRock, and then Two Sigma are like the biggest.
Yeah, I have it up. I'll show it.
Yeah, I'm seeing Vanguard, BlackRock, and Silver Lake. Can you zoom in? I can't see that too well. Got you. Okay. Yeah. I'm really interested in talking mainly about this CFO fireside chat.
Well, can we jump into the Wedbush note, and then I think that segues us to the fireside chat.
Okay.
Because I just think this is.
I'm just waiting patiently to talk about this thing.
Yeah, I know, but
okay, I did read this.
Community caught this. And I just thought it was really interesting. I talked about this in my video earlier today. Vadim posted tagging Wedbush around Dave Cavarini, who we know is, has a $3 price target on SoFi. Dave Cavarini was called out. I think Chris Hager broke out his bear case back in May, and he loves reiterating that bear case. So the funny point is that the bottom image is the transcript from Wednesday's conference where Chris Lapointe, basically addressed a lot of these cases. The top note is a reiteration of Dave Cavarini's note, which came after the actual the fireside. And essentially, Cavarini reiterates his $3 price target, says that the company did not provide at what level to which the losses are capped on. And then Vadim stitched these together where literally the day before Chris Lapointe highlighted that, the capped amount was in line with where the book was actually marked at the end of the quarter. So analysts, whether we like it or not, have a lot of influence on the stock. This is why people go through the route of, crying wolf in terms of manipulation, because you sometimes have blatant factual errors that happen here, and people will read the headlines and will make financial decisions based on those headlines that will affect the stock price, when in reality, a lot of the people in the community are way more on the button than a lot of these analysts. And it's really satisfying, at least to me, when the retail community finds these things and calls them out pretty openly.
Did you guys see there was another one that came out recently, not by an actual analyst, but by this popular person on Twitter, and I've seen a lot of his posts before from this Steven Cashflow University guy. Have you seen this? I think he has like 65,000 followers, and he posted this analysis on Sofi just recently talking about why he doesn't want to buy this stock. And I saw Chris Hager go through this point by point for why he doesn't like the company and why it just, and no offense to Steven, I just don't think he's looked deeply into the company. But some of his points were like, it says, he doesn't like it already because of the student loan risk. They don't have 100% control over that line of business as the government influences student loan repayment terms. And Chris pointed out that these are not public student loans. These are private student loans. The terms and the deals are completely 100% up to SoFi. So there was a bunch of miss points for what they thought the business was doing. They said there was a massive miss in that they're losing money last quarter. Obviously, that was on a GAAP basis for what versus actually happened. They said, this company, first rule of investing is don't lose money. Second rule is don't forget rule 1. SoFi loses a ton of money. It's like, okay, yes, but we're going to be GAAP profitable next quarter, and also we're not burning cash. It's just more things like stock-based compensation and depreciation that's actually bringing us into GAAP losses. So it's just a bunch of things, but this is reaching tens and tens of thousands of people, and it's just not quite understanding the thesis. Now, I don't think that this.
How about this? Nobody should be making investment decisions based on Twitter.
Yeah.
Like if you're making investment decisions based on Twitter, you're crazy. You should be doing due diligence.
No, I get that. And I don't think that SoFi is unique in the idea that people will make quick judgments to the stock. I'm sure that happens with literally every single stock. There's a lot of complex companies out there. But it is just crazy how much this stock can get brought down by the idea that people just simply aren't paying close enough attention to what management is doing.
Down by that? I mean, we can't prove that.
Sorry?
Can't prove that it's being brought down by that.
No, you're right. But whenever I still see, things on CNBC and they're calling it a student loan company, I think that does reach extreme broad masses, and that.
Well, so I do think that
not good.
When you look at unprofitable companies, like there's unprofitable and then there's unprofitable. Like there's a lot of these companies that are increasing the gap of how unprofitable they are every single quarter. Like they're going in the wrong direction. And then there's like with SoFi, it's essentially like a formality at this point if we trust what management has been reiterating all year long. And I found it really interesting because even in that fireside, let me see if I can share my screen. Even in that fireside, the host basically asked Christopher Lapointe to say, is this a concern? At what point do you need to sell loans or raise equity to continue to run the business? And I was thinking to myself in the moment, I was like, raise equity? What are you saying? And Chris Lapointe says, we have a plan that'll enable us to grow at the pace that we need without needing to raise capital ratios and maintaining really healthy capital ratios. And I'm like, the company is literally going to be profitable in Q4, and they're going to guide in that same quarter in January on that call that they're going to have a full year 2024 profitability every single quarter.
I'll go against you a little bit. I think that there is a route to raising capital, and it's to keep up growth rates. It's not necessarily for survival of the company, but it's to keep up the fast growth. So that's sort of the problem. Is I don't think even the bears are thinking that SoFi is going to die. I think that they just think that this company that's growing at a 30% rate is going to hit a really hard wall. And that's just going to hurt multiples. Not actually that I think the idea of survivability is one that's kind of over.
Okay, so let's talk about that, right? Because I know that you had a slightly more bearish take, or maybe let's say a contrarian take to the Chris Lapointe fireside than I did with regards to a lot of the forward-looking statements that he was making.
Yeah.
Essentially saying, well, lending is the bread and butter of how we make our money today. In 2024 and beyond, financial services and technology platform are going to carry more of that burden. In other words, saying that we're going to have a more equal distribution of segments that consist of our revenue mix. Now, that can be taken one of two ways. Number one, to say, well, lending is actually going to fall, and that's actually a bearish for SoFi. It could also be or pause, sure. And like I understand how you can make the logical leap to get there, because you can say, well, if we start cutting rates, personal loans originations is going to get hurt by that. Lending could take a hit in terms of their growth rate for the next year. The flip side of it is you can also say financial services is growing at the fastest clip out of all of their segments. The tech platform acceleration is increasing. Chris Lapointe basically talked about both the margin increases for tech platform in the long term being over 40% and the contribution to the revenue mix for tech platform playing a larger role. I think the linchpin of that is really going to be these RFPs that go live in 2024 that are now like coming towards the end of that validation process, let's say. And so those are essentially the two camps that you sit in. You either say lending rates are going to fall, and just naturally as a result, the other segments are going to make up a bigger percentage of the pie. Or you can say that, lending might stay the same, but the other segments are going to accelerate and far exceed the growth rate. And that's how they're going to make up a bigger percentage of the pie.
Yeah. So a couple points that I was saying, because there are a lot of people online who will take it the way I want them to take it and say, hey, Tanner, appreciate you looking at both sides of things. And then there are other people that are saying like, Tanner, you seem more bearish than ever. I'm actually not more bearish than ever. I've definitely been in worse positions holding SoFi than I am today. I'm actually quite positive. I just want people to know that we're not turning a blind eye to the bad cases. I want to pay attention to those, because that's the way I'm best going to understand both sides of the argument. We have to always remember that whenever a company gets depressed in their stock price, especially so much like PayPal, Disney, SoFi, some of these ones that have kind of done large sell-offs, that there are reasonable bear cases, and that not everyone on the other side is a complete idiot. Okay, there are people that put up good cases.
Just most of them that are complete idiot. No, I'm just kidding.
Most. But with SoFi and the tech platform, like even that they're talking about forward, like going forward. Sure, the contribution margin on the tech platform in the future will be 40%. They've talked about that for a long time, 18 months plus. Okay, that is when is the future? When is self-driving? When is Optimus? That's so forward-looking. It could be years from now. What they said is in the relative short term, that next quarter contribution margin will go down. They said mid-20s to mid-30s. Right now it's 36%. So contribution margin will go down. Lending, they said contribution margin will go down. I think currently, let me just take a look quickly. Lending contribution margin is nearly 60%. They said it would be closer to 50. We'll have to see. And they said originations are going to fall quarter over quarter. It wasn't all bright and shiny, especially whenever student loans are coming back into a strong wave coming into Q4. That I do worry where how strong will lending be, and it does seem like they're about to get capital constrained. Like they're literally warning people, saying, "Hey, just so you know, future growth is going to come from these segments, not this one." Is that because all of a sudden tech platform and financial services are going to outperform somehow? Because that's not what they said in terms of member growth either. They said we're going down from 700,000 back to 500,000. So there's no real wave in financial services. So the only thing is, I think that lending platform might get dragged down. I don't think that's a far stretch for assuming or putting those points together.
Yeah, but are you talking about just the immediate next quarter?
Yeah.
In Q4, or are you talking about 2024?
No. I think 2024 will be a great year. I think Q4 will even be a really strong quarter for SoFi. It's just not. I don't think that it will break a lot of people's, every single check mark. You know what I mean? I do still think that deposits are going to hit disgusting growth rates, and that people will come on the SoFi Money platform more than we suspect. There'll be more cross selling and everything like this. But if we have a hard time selling loans, that is going to capital constrain us. And like, I do not believe, like, whoever tells you that the idea that we're holding on to loans at 106 rather than selling them at 105, and that is management is doing that for our sake, and I will call Anthony and Chris Lapointe straight out. They are lying to your face. They're not doing it for you. It's because they don't have a buyer for those loans. Anyone who wants to say that I'm wrong on that,
You're
no.
wrong.
we will take a discount on loans in terms of how much they earn over the life of the loan to get immediate upfront payments. That's what selling loans is. That's what selling bonds are. That is what secondary markets for selling is. You always take a discount. That's just the case.
So you're wrong.
What do you mean? Who's paying more for a loan than waiting for it and accepting a default?
So they have the ability to either hold the loans or sell the loans. They're making a decision on what's best for the business. You're not in that position. I'm not in that position. Now, when you have loans at these levels, if their models are correct and their actuaries have done the correct due diligence, and these are high-rated loans, you're going into a situation where the Fed is most likely going to be pushed to start cutting. CME Group has already updated the charts. It keeps updating, and we could see a cut as soon as March.
Yeah, I think Maine is consensus now.
Yeah.
I mean, it continuously changes, but March is the new date where it's most likely we see our first cut. Regardless, there is not a situation that they're showing where rates don't decline in 2024. So what does that mean? That means that new debt issued is going to be issued at a lower interest rate and a lower coupon, meaning that old debt with higher interest rates and higher coupons is more valuable. So it could be more advantageous for them to actually hold the loans and sell them down the road because they'll catch a higher premium.
I agree.
You have to
with
understand
you.
how bonds work. You understand this, so you shouldn't be saying certain things.
No, I agree with the idea that we could sell it for a higher premium later. The problem is that there's so much supply out there that if we sold $1 billion worth of personal loans, we would recover it instantly, same quarter. So there's no point in we're not waiting. They're selling 15 million in loans or selling $1 billion. We would replenish that in the exact same quarter.
But once again, they are making a business decision. We're not seeing
They are making a business decision because they don't have a market.
Decision, and what I'm saying is they can do either or. Like, they have the ability to sell loans now. They've shown that they have the ability to sell loans, and they've also said that if they feel that they can generate even the slightest bit more alpha for shareholders by holding them for longer, then if they feel that that's a benefit, that's what they're going to do.
But like, I think both things can be true, right? They don't have a market because it's a high rate environment. And if the market anticipates rate cuts and they can get a better return selling the loans as rates come down, like, both things can be true. It's not necessarily that it's like one stance or the other. Like, they don't have a market today. Next quarter or in 2 quarters, they will have a hell of a market and they can get a better return for them. So I don't understand what the problem is.
I don't think both can be true. So the
Tanner,
buyer
did they
would
sell loans in Q3?
Sorry?
Did they sell loans in Q3?
A little.
15 million.
Okay, but did they sell loans in Q3? I didn't ask for a number.
Yes. But think about this. They originated 3.88 billion, and they sold 15 million.
Okay, and did they do a deal with BlackRock?
For Q4, correct.
Okay. So they have a pipeline to sell if they want to sell, correct?
We don't know how much they're going to buy, but yes, they've started a partnership with BlackRock.
Okay, just stop.
I'm mostly
Let's
with
just
Steven here.
trust that they know what they're doing, and if not, we're all screwed. How about that?
I agree with Steven. I think that's absolutely what they're doing from the comments that I've read and heard. They I think are seeing that soft landing scenario happen. So as long as there's no recession and things continue to they begin to reduce interest rates, and it seems like there's zero possibility of a raise, barring something absolutely crazy. It's minuscule. That's everything is over the last couple of weeks has been revised basically in the favor of this. So if that's the case, them holding on to these very attractive loans that, yeah, they can sell later, but they can just hold them on the balance sheet, and they're willing to, it seems like, assume the risk right now of being capital constrained, uh, and holding these just so that they can have that maximum shareholder return. So if that shifts, they can offload them if they need to. It will slow growth a bit, but I don't know. They're saying it's worth the risk. And yeah, this is a Texas Ranger shirt. So
I just don't understand why they can't, if there is a market to just sell a ton of loans, for them to sell, $1 billion worth of loans this quarter, and then like accept 105% premium, and then literally go back out and get your 106% deferred over time. Like if it, like, you would just be playing with more money at the end of that trade. You know what I mean?
I don't think they can do that. So like on your guys' side, yeah, that makes sense. Like they may be able to possibly get, but it's not a guarantee that they're going to get even just a slight markup. It might just be you're just swapping one exact thing for another. It's
but it might even be a better, like to get the loans off the book that are on our book today might even be better, because the coupon rates of the new loans might even be higher. So our average coupon rate on our book has gone up every quarter. And so and even the book that they did sell, that 15 million, was in a higher average coupon rate than what our total book is, which means we lowered our average to sell that 15 million. I'm just saying, like, let's be honest and say it's not all sunshine and rainbows. And that's why the stock goes down 7% after that CFO call. And everyone's going, it's rigged. It's like, no, not everything he said was great. He said a lot of things were not good. And then everyone's focusing on how he killed the current bear case. You created new bear cases by saying a lot of these contribution margins are going down. Like, are we all going to be blind to that? Like, you guys make me seem like a bear. Like, I'm not, like, this isn't the biggest fintech I hold, but I'm just not being silly to the idea that stocks don't go down 7% on nothing.
Yeah, but Tanner, like, I don't like everybody. I think it's a known at this point that in a high rate environment, that it's going to be a shitty environment for selling loans. Yeah. Everybody is looking 6 months into the future as to when rate cuts are going to happen. Because if they happen in Q4, then that's obviously way worse for SoFi than if they happen in Q1 with regards to the market for them to sell loans. If management could have done what you're saying, which is to sell way more loans this quarter and then do the same thing next, like, they would have done that. And so this is why I'm saying, like, both things can be true, but we have had awareness of the market that we're in for quite a while now. The market is forward looking. So I don't necessarily think that there is a justification for such a big drop if people have been actually paying attention to the type of business that SoFi is in the type of market that it's in.
Well,
So,
and
don't
one other
forget-
factor too is the management, the type of management that SoFi has. Like, they not been very transparent and clear, and when there's need for communication, clarification, they do that. If this was management like Lending Club, no offense, if somebody holds Lending Club, yeah, I mean, maybe you don't trust them fully, or if it's like Teladoc, completely different management, completely different company, where they have a history of missing all the time and pie in the sky dreams, and it never really materializes. Yeah, you sell, you get rid of that, it makes sense. But this is SoFi; they've been executing very consistently, and so for me, it's like, okay, there are some things to clarify. Management did that. Yeah, it's not all like sunshine and rainbows, but I trust them. That's the bottom line, and they've given me no reason to not trust them yet. If something changes markedly, we'll see. But yeah,
I think that there's
Tanner, don't forget
there's comments like this where people like, capital constrained means at this point just means that they're making the max amount of money off funds available. That's not true. Like, I mean, yes, that's true in the sense that, okay, you're making the highest coupon rate, but like, SoFi used to flip over their balance or their book like 50 to 60% every quarter. The bank charter allows us to hold for longer, and so they can have flexibility. And they are utilizing that flexibility to the max right now. That's what's allowing them to hold these loans so long. That doesn't necessarily mean that that's the most optimal strategy. Okay. These are held for sale loans, not held for maturity, and we have that flexibility. But yeah, there is reasons to sell loans. Let's not discount it.
So don't forget that
Wait, can I add real quick, Stephen, that if they just updated the numbers on how many loans that they accept for how many people actually sign up. The SoFi Money average FICO score, okay, is 743. The SoFi personal loan, average personal loan FICO is 744. Okay, so the people who apply for a personal loan is the same people, or is the same area for which their credit box could apply to personal loans and SoFi Money. In that case, Chris Lapointe updated that they only accept 25% of personal loan applications, which is actually a great statistic. It means that there's a ton of demand for personal loans. That's really, really good in SoFi's favor. But it also must show you guys, that if we're only accepting 25% of loans, which hopefully across the board are have a reason to be high FICO, that there is a problem to sell the loans if we could refurbish them or replenish them instantaneously.
So what you're saying, just to reiterate, is like the reason why we have 25% acceptance rate is not necessarily due to the stringent underwriting criteria, but more so to the capital constraints.
Yeah, the more capital constrained we get, the higher the tightening on our credit box goes. If that's why, we make such a small margin on the student loans in this credit box right now that the FICO just skyrocketed, like 781, average personal income over 180,000. It's not because every single person that has student loans out there has an amazing amount. It's just that we don't want to be accepting an unbelievable amount of student loans, so we can tighten until the cohorts get exactly where we think it's acceptable again. But that's capital constrained.
So don't forget that SoFi could have been going down because there's more of a reason a recession is imminent. And traditionally, financials have not done the best during periods of a recession. Now, I was in the camp that we were going to avoid a recession for the longest time. And an inverted yield curve does not necessarily mean that a recession is going to follow in 6 to 9 months. But what is alarming is bankruptcies are up and the unemployment rate is ticking up. And you look at the past 12 recessions, they have all occurred when unemployment has gone up by roughly 0.8 to 1.2%. We are in a position where a recession could actually be on the table for Q2, Q3 2024, and people could be positioning ahead of that and getting out of financials. That is a real scenario that could be impacting SoFi. You look at some of the other financials, there are several other big names that are not where they were a couple months ago. And this is more, my opinion, a reason why than other things. I mean, according to this chart, is the gray bars are recession periods and the blue line is unemployment rate. Every single one. Recessions happened after you gone up by roughly a percentage point. It's followed pretty quickly. We're almost there right now. And when you actually look at bankruptcies, it is up. I believe Chris, Matt, and I looked at this the other day. They're up, I think, 4 or 5 quarters in a row, quarter over quarter.
I think in their projections right now, SoFi, is that they're expecting for 2024 a 5% unemployment rate and a 2.5% GDP decline. Is their expectations what they're going off of?
Yeah, I love the guys at SoFi, but they were really right this year in what was going to happen, weren't they?
I don't remember. What did they say?
They were
about rate cuts.
Yeah.
Well, everybody said that though.
You're a little frozen, Steven. Can you try stopping your camera and turning it back on for a sec?
Yeah, they expected rate cuts would happen by now.
That was most of the major institutions anyway. What was interesting to me that came out, and we'll see if this plays into the narrative, was Walmart. Like, I know it's not exactly a fintech, but did you guys catch that news as far as like why Walmart dipped so aggressively?
No.
I saw
It
they
may not have
hit
been
some
today, may have
target
been
now.
yesterday. But yeah, they're predicting basically deflation, deflationary thrust, and so they give a very soft guide for next year as a result, which it's interesting. If
Steven, you
deflation
still there, my
hits,
friend? No. Sorry, go ahead, Roy. I'll send him
see,
the link.
that's an example of deflation right there. There was 4 and now there's 3, so it's playing out just like Walmart said.
I love Sicario's comment. Steven got banned for plagiarism. Get your fake ass bricks out of here.
Oh man, but yeah, no. If deflation actually starts happening, that is the Fed's worst fear of any possible thing they can. That's like their nuclear or war. And so, if deflation actually starts occurring, they will begin to cut aggressively. As far as being capital constraint, that'll no longer be an issue. There will be other issues.
Oh,
that
we
SoFi
saw the no
face.
bricks there for a second. Sorry, I just.
I want to be like Tevis.
Are those fake, Tevis?
It's
Yeah.
fake.
Yeah.
They're real.
All
They're
those
real.
fakes.
I've been there.
No, on mine they're fake. I want to be a fake Tevis. The same way I wear a backwards red hat when Chris Patel and I are on the same thing.
Yeah, so I want to pivot us to another interesting conversation, but just before I do that, I think, aside from the loan sales aspect of Chris Lapointe's fireside, there was a lot of other interesting pieces that he chatted about. Maybe we can chat about those a little bit, and then we can sort of pivot. What do you
So
guys think?
I missed that. Sorry. Can you repeat yourself for a second?
Some of the other pieces that Chris Lapointe highlighted on Wednesday, other than loan sales, I feel like we've beaten loan sales a little bit to death.
That was all the bad. There's a ton of good in this call here. One of the things that I thought was very interesting, they said that there's several hundred million in TAM for SoFi money accounts. And if you guys remember back all the way to their first presentation, back whenever they were like Social Capital IPOE or whatever, they said there's 500 million accounts just between the top 15 banks. Okay. So there is such, and then there's another 50% that's all on, all the other banks there. That there's so much total addressable market for them on the financial services side. And they're growing like crazy. Just on the 2 million accounts that they have today, they've grown deposits by $15.7 billion just over the last little bit. They said that they want to get their deposits up. Right now, it's making about 65% of total cost of funding, and they want to get that up to 80 to even 90 plus. I thought that was unbelievable. So very, very interesting.
Yeah, and they said the next several quarters on that, like as deposits rise, it's 15.7 billion right now. As it keeps going up, it'll go from 60% funded by deposits to 80 to 90% in quarters, not years, quarters.
Yeah, which should bring up the contribution margin as well for lending, because we spend so much right now on like people think that SoFi is offering a high cost for their checking and savings account, but I think we pay on average like 3.8% for that, because there's also people that have money in checking, stuff like that. I think it's 3.8%, and on the other side, I think warehouse facilities is something like 6.1% or something. So it's incredibly high. If we can lower that, like the profit's ours. What do you guys think about that in terms of SoFi money? They said gaining share in every single product that they offer right now. I thought that was interesting as well. What do you guys think?
I mean, we're seeing that it's not quite the same thing, but the last quarter that the contribution was positive for every single aspect of the SoFi business, and so they're growing at different rates, and there's always going to be challenges of some sort in the macro. Like right now, home mortgage business is not looking so great. The student loan business last year, it did not basically exist. So there's going to be seasons for all of these. And the great thing about what Anthony Dodo has done with SoFi is, instead of being basically a one-trick pony, they have multiple vectors. They're expanding actually in all of these. They're growing at different rates. And so when one is just flying around, it can carry some of the others that are lagging a little bit. So it's a much stronger business than it was pre-COVID.
Yeah. They always did say that they wanted to get each 3 segments to 33% each in terms of diversification.
I don't know if that'll ever happen, but we'll see.
Yeah, I
That's
think
the dream.
even for their expectations, they said in 2025, lending would still make up for like 40 something percent. But they did say this quarter, in 2024, I meant next year, they said they want to get lending to 50%. Right now it's at 62%. And the other 2 are going to make up the other amount. So could be large growth there. Yeah.
Tech will be, I don't know. I think tech may one day be more than that, but it's going to be slow. Like, just don't have. And they've not guided for anything other than that. They've been very clear on tech growth and what's down the pipeline, but that just has such a long sales cycle compared to, selling loans. It's like easy.
I was reading back on some comments that Chamath had made about SoFi whenever he was first posing this as a deal. And this was back in 2021, where they said Galileo services 90% of all accounts in the United States that are under neobanks. Now they're trying to go after large financial institutions. So the tech platform has a ton of growth and obviously has been wildly successful in the past. It's just about getting to that. We're kind of having a business shift there in the clients that they go after. And even SoFi is even having a business shift right now of the types of products that they want to push. So lots of growth ahead.
I sort of want to pick up on that tech platform comment, but I just want to cover one last thing that I found really interesting that I want to make sure doesn't go unnoticed. On the cross-selling and also on the growth, talking about like the CAC cost and the payback periods, Chris Lapointe said about 30% of all new accounts that are taken out of our platform are coming from existing members on the platform, so the cross-buying, where we're not having to pay that second customer acquisition cost. And then he continues to say, and right now the payback period on direct deposit members are less than 12 months.
Yeah.
And every single public appearance that they've had, every single sort of quarterly earnings result, we get a lower and lower and lower payback period. It was like 2 years, and then it was a year and a half, and now it's like, less than 12 months where they're seeing instant payback, near instant payback with a lot of these users. And they're seeing the users actually referring other users onto the platform.
This 30% payback for direct deposit users, right?
Exactly.
Which are the really expensive CAC cost ones.
Exactly.
Yeah.
Like subtle, I think it's easily missed, but
I missed it. Yeah.
It shouldn't be.
Yeah, I missed it. I'm glad you brought it up.
I didn't realize that it was just for direct deposit, because they literally say like that's where they can put a lot of the extra customer acquisition costs in, because it could mean multiple products, it can mean a lifetime member, it can mean so many things. But yeah.
Okay, so
sorry, go ahead.
I wanted to just touch on the tech platform point and sort of pivot us, unless you had another topic, Enter.
No, I was just going to add a couple small details about student loan stuff. I'd rather hear about tech.
Okay. So I want to show this post by Chris Hager. Basically on the back of that Chris Lapointe fireside, Chris Lapointe basically said, he said towards the revenue split that it's going to be more 50-50. So 50% for lending and then 50% for financial services plus the tech aspect. And then just doing some math, the overall conclusion that we come to is that the tech platform would have to increase by a pretty big amount, in 2024 to achieve that 50-50 split. Now, this can be in 2025, it can be in Q4 2024, which is what Chris is highlighting here. But I think the more interesting topic of discussion is, I sort of reposted this, and let me see if I can find it. Yeah.
Yeah, but let's not misquote it though, because it's not 50% and 50% financial services and tech platform. It's 50-50 between lending and on the other side, tech and financial services.
I get it. So this is what I said, and what I want us to sort of chat about. I said if SoFi revenue mix for 2024 is a 50-50 split, so 50% being lending and then 50% being FinServe plus tech platform,
Gotcha.
when does the market start to give SoFi a tech multiple? Is that 25% of revenue from tech, 40%, 50%? Like tech as a percentage of total revenue is going to rise drastically, not only in 2024, but 2025, 2026, as these RFPs get validated. And, you know, I think it's really interesting because it goes back to that conversation of like SoFi is just a bank. At what point, as a percentage of total revenue, does SoFi get a hybrid valuation?
Two things need to happen. Why are you laughing?
No, yes, I'm engaged.
Two things need to happen. You need at least, my opinion, 20%, if not 25% of revenue to come from tech. And you need big name clients to be publicized and them start to show that they have 5, 10, 15% penetration into the underlying banking systems that they're controlling. So they need to show that of all the banks and all the money spent on it as market share, that they're getting 5, 10% of the pie and it's growing and there are more RFPs because they are still perceived as a student loan company. They are in the financial service industry. For them to get a hybrid, I don't think we're going to get a tech multiple. I think we're going to get a hybrid multiple somewhere that's between financial services and tech. But to do that, they need to be able to say, I have no information on this. The only thing that we know is that they won a large regional bank and they have some large scale RFPs that they're currently doing well in. Hypothetically, let's say that large regional bank is Truist. Hypothetically, let's say some of the large customers are UBS on the big side that they're in an RFP with, Citibank, some of those. We know it's not JP Morgan because they're using Think Tank or whatever it is to build out theirs.
Also, though, the virtual card for JP Morgan is actually done through Marqeta, which gave me some confidence to know that some of these big banks will disclose who they're working with.
So they need to show that they are not just a financial service institution, but their combination of Technesis and Galileo is powering their competitors, because then the narrative can flip from financial services to they're not just winning at financial services and getting the younger generation involved and generating capital from that, but they are powering their competitors and they are the underlying architecture behind their systems. You look at Palantir, you look at the valuation, you look at the valuation of other tech companies. When that narrative gets out there, once these companies switch, they're not switching again for quite some time unless something seriously gets screwed. So that's going to be what needs to happen.
Yeah, and I like what you said about, you know, flipping a switch. It's not that they have this much revenue percent coming from tech, and so then they get that percent of the multiple. The narrative goes from it's a bank only, tech does not exist, to okay, yeah, it's a tech company too. It's a conglomerate. We're going to give that, and you'll see a meteoric rise at that point in valuation. And typically, it takes a while for the narrative to shift. I personally think more than the percent of gain from the tech platform or the percent of growth, however people are looking at it, it's those big names that you mentioned. If they get several big names, like you said, those are clients, maybe not for a lifetime, but for a long time, especially some of the dinosaurs that may be signing on with them. And so people will realize, okay, this is actually happening and it's real. And if these old guys are actually signing on with SoFi through the Galileo platform, yeah, this is actually happening. We'll assign that multiple gladly, and you'll see a lot of revision with the price targets. Of course, some chasing the price action as well.
Well, I thought it was really funny. I saw some people on Twitter, I don't remember who, but they were talking about how the majority of growth that happened for SoFi's tech platform this last quarter was internal, and so they didn't really see any growth. And I was like, they added 7.4 million accounts. Like, what part of SoFi's growth has we don't have 7.4 million members in total. Like, so 7.4 million is a large ad in a single quarter. There could be some massive, like that could be the start of some pretty big clients already coming on. That could be Who knows?
Well,
We haven't seen that in a little bit, in like about a year since we've seen that many clients ads.
I remember in the last pod when we were talking about, the comments made that SoFi is just a bank, and we talked about the revenue mix or the contribution that the tech platform has, and it's really interesting to hear Steve say, well, 20 to 25% as one of the two components to having a hybrid multiple. Obviously, I think the second component is going to be harder because of non-disclosure agreements and such. If I was, JP Morgan, I wouldn't want to advertise that I'm leveraging SoFi. So I think that piece is going to be more difficult just given who they're working with. But 20 to 25%, I don't think that's that impossible, because Tanner, keep me honest, but right now the tech platform is something to the effect of 16%.
16.3% right now. Yeah.
So Chris Lapointe basically says, okay, if it's going to be a 50-50 split, lending on one side and then FinServe plus tech platform on the other side, that corresponds to something like 20 to 25% tech platform contribution of the revenue mix, and it's already at 16. And we know that the margins are going to go up as well. I think that can happen sooner rather than later.
And it can help dispel the narrative of student loan company or it's just a bank, because they're really a financial institution, and a financial institution has all these components. And you can even make the argument that a financial institution can be in the business of creating their own software to run on. That's not out of the realm of what they do, because who would know what they need better than them? So, when I make those comments that they're not just a bank, they're financial institutions, because they do so many things other than banking that is still under a financial institution ideology.
Hey, I mean, back in Q1 of 2021, the technology platform was 23% of revenue. I think that's the highest. I'm just going through 22.6 in Q2 of 2022. Yeah. So essentially, maybe we can get back there. We can demand a larger multiple, but it was also a different time in 2021. But yeah,
it's shifting macro. It's like some of these, one of the segments will be thriving, one will be okay, and one will be kind of sluggish, and it just depends. This has not been a favorable macro for the tech. It just hasn't. Companies haven't wanted to make a switch, so.
I think it'll also help with a narrative around the overpayment for Technisys in general, and the goodwill impairment and the drawdowns they had there. It could also be like a justification. Sorry, go ahead, Steve.
When you say overpayment, more people have been saying overpayment. They didn't pay $1 for it. They diluted us.
Sure.
Did $1 come out of their bank account? It was all stock. They diluted the shareholders.
Yeah, okay, we overpaid for it.
It's still goodwill impingement, so.
It's goodwill, but they didn't use cash. They diluted shareholders. I would rather them acquire an asset that's going to be strategic, that over time, it could take 15, 20 years, but it's going to pay for itself. I think it's going to take a lot shorter than that, but just on the amount that they're saving on an annual basis, the 60 to 70 million, they're going to pay themselves back on those costs over 13, 14 years, just on those costs alone.
And I think they said there'll be additive an additional 500 to 800 or accrued of 500 to 800 million dollars by 2025 or through 2025 from Technisys as well.
Yeah, I have 2028 in my head, but it could be 2025. I don't remember. But it's in that presentation that they put out.
It could have been 5 years, and that's what I'm thinking of.
But it goes back to how you utilize your stock. They utilize stock at a much higher share price to acquire Technisys. I think it was around $11 or $12. So it's not a bad deal whatsoever, as long as shareholders are living with the fact that they got diluted. And quite honestly, any shareholder, anybody who's buying this stock that doesn't understand that shouldn't be buying this stock. You should understand the ramifications that management can dilute you to grow. Look, Tesla shareholders have never complained about being diluted to grow, and it's worked out great for them.
I've seen some people complain.
Let me find the middle ground and just rephrase. I think it makes the dilution an easier pill to swallow if we can justify the tech platform as a higher percentage of the revenue mix in 2024.
100%. Yes.
Yeah.
There you go.
It makes it just even sillier, with that Twitter argument, that not an analyst, but the guy that you brought up saying unprofitable company, forgetting the first two rules, which is one rule, because of a goodwill impingement that was paid for in stock. It's like what are you talking about? Like, that's the dumbest reason to say, oh yeah, company's not making any money, they don't know how to make money. It's like, no, they're guiding for profitability and all the way through 2024. So,
and not every company is profitable their first quarter or their first year. I mean, that was a big argument with Amazon, that they were unprofitable, they weren't pulling the lever, blah, blah, blah. I mean, it's been like that for many different companies.
And if I understand correctly, I don't. The goodwill impingement did not have to be taken that way at that time. They just chose to get it over with. They're like, you know what? Let's just swallow the pill.
I mean, it did.
And
It did, because then they wouldn't keep their promise of Q4 GAAP profitability.
Okay, yeah, that's fair. I was like, there must be something I'm missing, but yeah, you're right. Yeah,
It was the last quarter of unprofitability that they could have possibly done it.
I'm pretty sure whenever I read the 10Q, and hopefully someone corrects me if I'm wrong, but that it said it was a goodwill impairment from both Galileo and Technisys. So I think they're just writing things down. Which, hey, do it on Q3, because this is the last bad quarter, and then hopefully they said their contribution profitable for all 3 quarters for the foreseeable future. They don't expect to be going back. So this is a new era for SoFi investors. And I just want to claim, because I know I've been, as some people are saying, I am the David, what is his name? Chevrini. I've been unmasked. To be honest, okay, I think that one thing that bears, and this is for every stock, has a problem in doing, is that they notice a problem that might be in the stock currently. What they don't ever attest for is that management will change their mind, that their pivots can happen, that the focus or mission can change. And so whenever I see SoFi, the one thing I always have to remind myself is management is so fast, they're so quick and so agile. And the idea that, okay, lending's not working right now, full pivot to financial services and technology platform. We'll run out the payments on loans. We'll sell what we can with good partners. But truthfully, we want the majority coming from non-lending services, and we will continue to hold up great growth rates.
So Tanner, let me ask just you a question.
Do you want to ask me on the SoFi after hours?
This is a good way to end it real quick.
Okay.
Chris Lapointe, when he had that fireside chat, more bullish, less bullish, or the same for SoFi for you?
The same. I think I'm extremely bullish. I've expected large growth rates. We're going to have that. The macro sucks. Yeah, it's the same.
So guys, Tanner's just looking at it from both angles. You should do that as an investor. You should look for a bear thesis, a credible one. There's a lot of incredible ones. And that's all he's doing here. He said, things changed, but he's still incredibly bullish. So don't call him a bear.
Yeah, I find that people that don't do that with their stocks don't understand what they're holding. Like, you got to look at it from all angles.
He's always late, but he's not a bear.
Okay. Ladies and gentlemen, if you have a membership to either Tevis or myself's channels, you will see the FinTech Frenzy After Hours show tomorrow.
My weekly After Hours show.
What did I say?
FinTech Frenzy.
Oh, I got too many things going on. SoFi Weekly After Hours. We're going to go record that right now. If Roy can join us, that'd be great. If not, understandable. But
It'll be posted at noon tomorrow.
Thank you all so much for watching, and bye for now.
See ya.